class on financial reporting. So we'll be taking that today. We call it payroll accounting. Payroll accounting. So what does payroll accounting means to you? Can I hear your view before we start this? Payroll accounting, what does it mean to you? If you want to talk, you can either enable your mic or talk through the chat box. What does payroll accounting means to you? How have you been accounting for payroll related costs, particularly for those who already had financial reporting role? Okay, Francis just confirmed that accounting for staff emolument. Okay. Any other person? Any other person? What does payroll accounting means to you? Okay, Khadijat says payroll accounting is accounting for employees' remuneration. Okay. Is there any related standards that relate to payroll accounting? Any IFRS that is very close to accounting for payroll? Any standard? Any standard that you are aware of that is a bit close to payroll accounting? Okay, Olajumoke is saying payroll accounting is a calculation and analysis of employees' compensation. All right, so let's go on. You will not only understand how payroll is being accounted for, but what are the various, what is the impact of these in financial reporting? And what is the tax implication of these? What are the other related costs that may be peculiar to this? So our outline today will be as follows. We look at what payroll is. We explain the differences between gross salary and net salary. What is the difference between it? We would also relate this with the provisions of amendments in tax, which further says there could be a difference between gross salary and total emolument. We'll be considering that too. We'll also look at explaining and calculating the difference between employees and employers' defined benefits contributions, right? We will look at stating the control procedures required in the management of payroll. What are those controls that you think will be crucial or necessary for you to, that must be installed in a company's process if you don't want the payroll-related functions to be grossly abused? It is also important to emphasize that in a structured company, whose responsibility or who should actually take responsibility for accounting for payroll, who manages the payroll, who prepares the payroll, how is payroll different from payslip? How is it different from master payroll? How is it different from payees? These are some of the salient terminologies that we have to decipher in the course of our class today. We'll also look at understanding how to computing payee and PIT. Don't forget that payee relates to those in paid employment, and the full meaning of payee is pay as you earn. While the twin of it is PIT, personal income tax. That is peculiar to everyone, be it those in paid employment, but that have other sources of income, or those who are in a self-employed engagements, or those who are high net worth individuals. Please don't forget that the concept of high net worth individuals, it's is peculiar to very peculiar to Lagos. Abdullahi, please mute your mic. Abdullahi, mute your mic. So we'll look at the differences between these. How do you calculate the payee for an employee? How do you calculate the payee for an expatriate? How do you calculate the PIT for traders, self-employed, or business owners, or high net worth individuals? We'll be looking at that in the course of this class. Should you be required to calculating this and making provisions for this in the account? What happens to the result of your computation before 2019 Finance Act, and what happens to it after 2019 Finance Act? Yeah, we'll be looking at that. Then understanding the double entry postings of payroll is also very crucial. Can you please mute your mic? So understanding how to make the relevant accounting postings in the ledger. So here we start. Please, if you are really ready for this, can you communicate hi on the chat box? If you are ready, indicate hi. Khadija, you are cited. Okay, good. Okay, so we are good to go. We are good to go. So what is payroll itself? What is payroll itself, and how is it different from every other spreadsheet that we might call payee computation? What is the differences between payroll, payslip, payee, and what we call master payroll? The term payroll means a list of employees within a company and how much they are to be paid. But nowadays, it is more commonly used in reference to employees' wages and making a record of the amount of money an employee has made over a period of time. No standard has exclusively been able to define what a payroll is, but from experience and in practice, we expect and have seen that payroll contain various components of the emoluments payable to staff in a definite or a defined organization, right? So sometimes this word is often used alongside with payroll management. So when you say payroll management, what are you actually referring to? You are trying to structure the components of the payroll in such a way that you have minimum exposure of cost to the business and minimum exposure of tax to the employees or the earners of those payroll. So it is very important for you to be able to differentiate the two. Sometimes, for the benefit of those who are in practice, employers might have or might be complaining that they are looking for better options around the structure of their payroll. So there is a common service we do render in this aspect, which we could call payroll management or payroll restructuring, right? For the benefit of those in practice, we can have further discussion on this, but that is not actually what we are looking at today. Anytime you see the word payroll, what we're simply referring to is costs relating to staff of an organization, and it does not just show the cost in total, but rather shows various components of these costs, right? If you work in an organization that the payroll or the compensation to staff is not analyzed in a distinct manner, you probably might look into advising your employer or your clients to doing so, because there are a couple of advantages that comes with this. We will see in the course of this class. So what is the difference between gross salary and net salary? Let's put that as a discussion. Please, if you have an opinion on this, you can either enable your mic or use the chat box. What is the difference between net pay and the gross pay? Any opinion?
Yeah, good evening, sir.
Yeah, Damilola, it's good to hear from you. Good evening.
Good evening, sir. Yes, sir. So gross pay simply means the total amount of money that is payable or that is due to a staff based on the position and the based on the post that the person occupies. While the net pay is the amount less the tax and other deduction due to the person.
Okay, so but if the term gross pay is mentioned within the context of Finance Act, what does it mean?
Okay, that would be I'm not
Don't worry, you've
sure.
tried. Let's give the room for others to contribute. If the term gross pay is mentioned within the context of the recent amendment to our tax law, what does it mean?
Come again.
Abdullahi Yahaya, you are disturbing us. Okay, I think we'll have to make a rule now. Anyone that disturbs us will delete the person from this training section throughout the semester. If you are talking, make sure that there is no background noise. And after you finish talking, please mute your mic to avoid distraction. All right, so can anybody confirm? Khadija says here, gross pay is the total salary or wages before deduction of tax and other deductions, while net pay is the total amount given to the employee after deductions has been made. Okay, but I want us to define gross pay within the context of the recent amendments made to the Finance Act. Anybody? Anybody? Oh, should I call names? Jumoke? Is Jumoke on this forum?
Yes, I am, sir.
Okay, do you have any idea of the definition of or what gross pay means within the plight of the recent amendment made to the Finance Act?
No, sir.
Okay, it's Danjuma on this platform. Okay, is Fatima, can we hear from you? Is Fatima there? Okay, Yusuf, do you have anything to say?
No, sir.
Oh, okay, so because additional, do you have anything to say? Additional, Rebecca?
No, sir.
Okay, so let me quickly explain it. So generally in accounting, when we say gross payroll, right, we are actually implying or referring to the total component of the compensation made to an employee, whether in kind or in cash, right? You know, instances whereby an individual is an employee of a company and a house, and he has or he or she is being given an apartment for residence, right? That component of the money of the benefits is not given in cash, it's in kind, right? So you have to look at all the benefits, whether paid in cash or otherwise, that is accruable to an individual that works with a company, right? But when we say gross pay within the context of tax or the recent amendment made in the tax law, gross pay is actually different from what we call gross pay in accounting is actually called total pay in tax, while the gross pay is the difference between the total pay less all the reliefs that must have been given to the employee. What are those reliefs? Like the pension, like the NHF, like the HMO, if it is borne, if it is to be bared by the employee, right? That is why you observe that by the time we'll be doing the payee computation, right? Payee computation before 2019 is different from payee computation after 2019, right? Before 2019, our estimate of the consolidated relief allowance is tied to the gross, it's tied to the gross pay before 2019 because the tax law did not actually differentiate total pay from the gross pay. But with effect from 2019 and thereafter, there are differences between how you estimate your CRA, because the CRA, because your CRA is now tied to your gross pay and not your total pay. While the gross pay is the difference between the total pay and all the benefits such as pension, NHF, HMO, and other reliefs. You will see that by the time we will be looking at payee computation. So you need to take note of that because that will have impact on what an individual could likely pay as payee on its income before 2019 and after 2019. I hope that is clear. Ogunwale, can you hear me very well now? Please, if you can hear me, can you indicate hi? Okay, okay. It's true it's raining from Abuja, but I just want to be sure that the network is not affected. So that we are good to go. Everybody could hear me, right? Okay, 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 good. All right. So I believe you all understood the difference. All right, so let's look at the difference between the gross pay and the net pay. Within the context of financial reporting, there is no difference between gross pay and total pay, right? So here we are using gross pay as meaning the same thing with the total pay, right? But I've emphasized that within the context of tax, effective 2019 Finance Act, there is a difference between the gross and the total pay. So gross pay means the amount of money employees receive before any form of taxes or other deductions are taken out. By other deduction, we are referring to things like pension, things like HMO, things like NHF, things like premium contribution for life policy and the likes. So for example, when you tell an employee that he or she will be paid 50,000 naira in a year as its compensation, as its consideration for work done, with what that means is that is a gross pay. But that does not mean that that gross pay may not likely be subject to other deductions, whether statutory deductions or otherwise, and taxes per se. So what should form the components of the deduction in each company varies, right? So you need to look at the offer letter or letter of appointment that must have been given to the staff, and to understanding what is statutorily applicable and what the company in context actually recognize as deductibles. So whatsoever that must have been agreed among the employing parties as deductible, when you less this from the gross pay, what you have is the net pay. So net pay is the amount of money the employee take home after all deductions, including statutory or otherwise, have been taken out. This is the money they actually got on a pay day. I believe that is well understood. I asked a question at the beginning of this class that there is an accounting standard that is very much related to payroll costs, and unfortunately nobody could attest to that. What standard is IAS 19? IAS 19 is which standard?
Employee benefit.
Yes, so that is one of those standards that is actually very related to payroll related costs, right? There is another one that is somehow related to various staff costs. We call it IFRS 2. What is IFRS 2?
Share-based payment, sir.
Share-based payment. So these are two standards that technically are related to costs incurred in terms of as considerations of benefits to employees, right? So let's look at this defined benefits vis-a-vis defined contribution plan, right? What brings about this within the context of payroll is that the law actually provides that there should be benefits that is payable or due to employees after their regular payouts. So there are two very functions or approaches in which this is actually being maintained. For more information about this, you need to read more on IAS 19. IAS 19 expatiates this further. So employer-sponsored retirement plans are divided into two major categories. You have the first one, which you call defined benefit plan, and the other one is called defined contribution plan. So as the name implies, a defined benefit plan, also commonly known as a traditional pension plan, provide a specified payment amount in retirement. So what this means is that we are looking at what are those policies that every organization operating within Nigeria are expected to provide for their employees, particularly after their working lifespan, right? And we have said that one is called defined contribution plan, and we said the other is defined benefits plan. So let's look at the defined contribution plan and be able to differentiate the two. Remember, I said the defined benefit plan is also commonly referred to as a regular pension plan, which provides a specified payment amount in retirement. So a defined contribution plan allows employees and employer, if they choose, to contribute and invest in funds over a time to save for retirement. These key differences determines which party, the employer or the employee, bears the investment risk and affects the cost of the administration of the plan. Both types of retirement accounts are also known as supranations. So what we are trying to say, prior to the introductions of our current pension plan, right? The policy in every organization, particularly those who are working in the public sector, is that upon their working life period, when they attain the retirement age or retirement period of being in service, the employer, being the federal government, will have to provide for them what we call a defined benefit plan. So you will have heard people, the very set of people that are very old, the older generation now saying governments have not paid them their pension and all of that. What they are referring to is the defined benefits plan. But this has faced a lot of bottlenecks because the organization is expected from the period that each employee is being employed to, in addition to managing the day-to-day concern of the business, also, who is this? Grace, you are disturbing us.
Oh, sorry.
So, in addition to their day-to-day working concern or business concern, they are also distracted with managing the various investment portfolios that they could be putting those benefits to from the very beginning of the working life cycle of their employees till when they attain the retirement age. And this caused a lot of distractions. This caused a lot of concern. There are a lot of cash flow concern, such that by the time those who should be the beneficiaries of this plan are due to actually earn those benefits, the funds are nowhere to be found. Organizations are also tempted to diverting this fund and use it for their own selfish reasons. So it is in the light of this that the Pension Act was actually introduced, and that one makes the contribution, what will have been accrued as a defined benefit, to be contributed to a different or a third party, which we call the PFAs, right? So within the context of defined benefit plan, it is the company that manages those funds, right? But within the context of defined contribution plan, it is a company other than the employer that manages the fund. So upon retirement, the employer does not have any business with the employee other than an handshake, because all the benefit that is due to the employee upon retirement has been contributed to the PFAs. So the risk of cash illiquidity has been transferred to a different party, which we call the PFAs. That is, the PFAs are the pension fund administrators, right? The pension fund administrators are under the supervision of the entity we call the PENCOM, right? So the PENCOM is like a regulator to all the PFAs, and there are a lot of other structures that have been put in place to ensure that upon retirement, these employees can attain those funds that have been contributed to the PFAs over their working life cycle, right? But unfortunately, a lot of atrocities is happening on this in Nigeria. Francis, please mute your mic. Mute your mic, please. If you're on the road, to avoid distractions, mute your mic, please. So,
okay.
a lot of a lot of atrocities is happening in Nigeria, where we have that the federal government is even or has even borrowed the said pension fund contributed, or there is a lot of financial misappropriations around this. May God help us in Nigeria, but we are not looking at that context. What we are looking at today is what is payroll, what is the defined benefit plan, and what is the defined contribution plan. Which one is actually applicable to us in Nigeria, whether if we are in the private sector or in the public sector, right? How is this managed? Who actually bears the risk of financial illiquidity or risk of investment loss if a company is maintaining defined benefit plan and if a company maintains a defined contribution plan? Who do you think is actually or will likely maintain the risks that could come alongside with it in both of these plans? A question to you all. If your organization uses defined benefit plan, who bears the risk? Hello? Are we all there?
Yes, sir.
I hope there is no match today. All match has closed now.
No.
So tell me, do you understand my question?
Yes, sir.
Okay,
Yes,
so how do I pronounce this name? Is it Insan?
Yes, sir. San Victor.
Insan?
San Victor.
Okay, Insan Victor, you are from Akwa Ibom, right?
I'm from Calabar.
Oh, really? Really? So what's the difference between defined benefit plan and defined contribution plan? And who bears the risks in the two?
Sir, for my own benefit plan, is supposed to be in the public sector.
Speak to your mic. You are speaking far away from your mic.
Okay. So what I'm saying is that, like in defined benefit plan and defined contribution plan, in defined benefits, it's just like this one is associated in public sector sites because the government benefits more. But if defined benefits plan is being involved in private sector, the employee there will lose so much. But if it is in government sector, employee will enjoy the dividend more than in defined contribution plan.
Are you sure?
Yes, sir.
Okay. Abdullahi, can I have your opinion on this?
Okay. Yes, sir. I think it is the employer that bears the risk of a defined plan because the employee promise. I don't know. All I know is that employer bears the risk of a defined plan, sir.
Okay, can you explain what we mean by that defined benefit
Best
plan?
if defined, and that's the best form of investment now. Not this one for people. This one don't come and be harassing you from time to time. See, like that, no.
Hello,
Sorry, I
sir.
didn't get you very well.
This is a training. Your accountant is not actually attending. He said no data. Okay, is there that is there today?
Okay.
Raymond.
Sorry, sir. Hey.
Hello, do you want to say something to this question?
No, sir. I just came in. Please, sorry.
Okay, it's fine. It's fine. So what we are trying to explaining is this. We all must have had at one time or the other when some of these aged people we have in public service are complaining that government has not paid them their pension, right? So whenever an employer, after the working life period of an employee, is still responsible for paying the pension of his retired employee, what that means is that that organization must have adopted what we call defined benefit plan. And this defined benefit plan is usually peculiar with governments. But the government has identified that even though there is a regulation that compels employer to compensating the employee after their working life years, right? But they also recognize the fact that it is difficult to managing this fund over the working life cycle of the employees. So they created an institution outside the company's process, whose responsibility is just to manage funds that are contributed for the employees over their working life cycle. So you will have had a lot of organizations we call the PFAs. You will have heard about Asamasad pension. You will have heard about Leadway pension. You will have heard about premium pension. These are called pension fund administrators, right? Their functions is tied to defined contribution plans, not defined benefit plans, right? So defined contribution plan is very much common with in the private sector. So that is why you work for an organization 5, 10, 15, 20, or 25 years, any period you work for them, by the time you said you resign or you retire, that you are going, the employer is not under any compulsory responsibility to giving you any other compensation other than what must have been jointly contributed for you or for the employees through the pension fund custodians as being managed by the pension fund administrators. So my earlier question is, since defined benefits talks about the employer should manage the fund till when the employee retire, right? The risks of inability to paying the employee, as we often see in the public sector, when retirees are complaining that they could not get their benefits, right? Since this is always peculiar with the public sector, the risk of inability of being able to meet the financial commitments is tied to the employer, right? But if, say, company A adopts a defined contribution plan, right? At the retirement age of the employees, the employer does not have any responsibility to them. Whether the PFA manages the fund very well or not, it is not the employer's business. Whether they were able to paying the employees after their retirement or not, it is not the employer's business. So you need to know the differences between the two. So for most of you that work in structured organization, aside your net pay, there is a different contribution that is being made to your PFE. So it means your organization is using what we call a defined contribution plan. So I believe this is well understood now. Please, if you understand what I've explained thus far, confirm yes. Otherwise, you ask question.
Yeah, good evening, sir. So I have a question.
Okay.
Yeah, so it's Victor. So in terms of pension in the public sector, those that are working in public sector, that is the government sector. So I think that at the end of the month, there is a standing order that they deduct from that salary that they give to the pensions fund organization. So why is it that at the end of the retirement, the money that has been saved for them as a pension, the bank will not give them the money back. They will fall back to government again.
Okay, so let me actually put the right perspective to that. The most recent amendment to our pension law, pension act, was made in 2014. Was made in 2014, right? But the original one was actually before that year. Before the actual first pension act was actually introduced, I think in 2004 or thereabout, what we often use in Nigeria is the defined benefit plan, right? Meaning that employer may be maintaining separate investment funds or not, but at the attainment of the retirement age, the employer is expected to paying what we call either gratuity or pension to the employees. Do you understand? But after the introduction of the defined contribution plan, the government or the private sector is not in any way responsible to the employees. Are you with me now? So whether the fund is being well managed by the PFAs or not, it is not the employer's responsibility. That is why you as the employee, you are at liberty to choose your most preferred PFAs. And if you think that your PFA is not managing the funds very well, what you probably need to do is to switch or transfer your investments from one PFA to the most other preferred PFA. I believe that is well understood.
Yes, sir.
Any other question before we go on? Okay, so in the absence of any question, let's go on. We've been able to explain what we mean by what payroll is. We've been able to differentiate between gross salary, total salary, and the net salary. We've also been able to differentiate between these benefits and the contribution plan. Now, what is the procedure required in the management of payroll? I need a volunteer to help us in this reading while we thereafter explain. Volunteer, please. Any volunteer? Okay.
All right. The payroll process begins by defining the payroll policy. A payroll policy is a set of guidelines and regulations related to how payroll processing should be carried out. It describes various processes, administration of employee salaries and/or wages, time taking, payroll schedules, and payment method of an organization. The policy is defined to bring transparency into the whole payroll process, and make employees aware of their rights. That is all.
Okay, so thank you very much. What we are trying to say in here, okay, sorry, before then, somebody is just asking a question here. Esther says, is it possible to move from one PFA to another, just like that? Yes, it is possible. It is possible. So if you need further clarification on this, after this class, you can chat me. That is if you want to move or change your PFA from the current one to the other one, it's actually possible, irrespective of which of the PFAs you are using now. It's very possible. All right. So we're looking at procedure required in the management of payroll. What we have seen in most companies, particularly the startups, is that when they recruit any staff, they just discriminately allocate or decide what they will pay to each of the staff. So you could see instances whereby two people are on the same grade and they earn different income. Or even people on a lower rank may even earn more than people on a higher rank. So what every structured organization should do is to have what we call a payroll policy. So what would you have in a payroll policy? The payroll policy is a set of guidelines and regulation relating to how payroll processing should be carried out. Number one, it will outline the various organograms, the various grades in the company's organogram. It will identify what is the component of, what is the gross amount due and other compensation due to each of the grades. It will go further to identifying what is the breakdown, what is the various components of the total emolument. So that is why you could see that an organization has, as part of its breakdown of its payroll cost, they have what we call the basic allowance or salary, transportation allowance, housing allowance, chicken allowance, lunch allowance, health allowance. They could have as many as the company may decide. There is no policy or any law that says that the component of your payroll should be this or that, right? So every organization is at liberty to deciding what should be the component or what could be the component of its payroll. So in deciding what should be the component of your payroll, the cost of this payroll, the stages of the payroll grades, and the compensation that should come with the payroll grades, you need to have a defined or a definite policy that will include this. So as staffs are coming in or as they are being recruited, the HR department will translate the recruited grade and allocate the appropriate amount of payroll components of compensation due to them, right? So if your organization or your client does not have this policy, I think this is one of the unique areas you might be of service to them. And this is what we call in practice, this is part of what we call in practice payroll restructuring. So it describes the various processes. So it should tell you when you want to pay salaries at the end of the month, what are the things you should do? How do you certify that all the people on your payroll list actually have worked in the month and they merit the expected or the envisaged salary? So we talk about the administration of the payroll salaries and or wages, time tracking, payroll schedules, and the payments methods of the organization. So when staffs are coming in, you probably may decide that you want to use, you want everybody to have a salary account in the same bank to minimize discrepancies, right? Or the payroll payments related costs or charges. So you have to define at what point will somebody who has just been recruited be eligible for your offer letter? At what point will they be registered for pension? At what point will they be registered for NHF? At what point will they be required to open the required salary account? How do you, what standard operation procedure do you use in validating and ensuring that you don't have ghost workers, that is, people who should not be on the payroll, but have been secretly included on the payroll and they are being paid, right? So all of these processes are very essential in ensuring that payroll costs are well managed. For you, for those who work in a very smaller organization, you might not see the value in this, but imagine and seeing yourself as the payroll accountant of a company like MTN. Imagine the number of staff that will be or that should be paid at the end of each payment period. So this function is not just Abdullahi, this is second time you are disturbing us. Mute your mic. So this function should be very deliberately managed, right? So number one procedure in managing payroll is that you must define the payroll policy. And in defining the payroll policy, you should have what we call the payroll policy that should include the decisions of the organization with respect to the various grades in the organogram, what is due to each grade, what is the various components of their payroll, at what point or what day should be your salary payment date, and what other deduction should be tied to the payroll, whether in terms of pension, what is the rate of the pension contribution by both employees and the employer, or should the employer wish to contribute all the total pension, it should be well stated there. So I believe that is well understood. That is the first procedure required. The second procedure is Grace, we will delete you from this semester. You are disturbing us. So I need a volunteer to read in the next one, please. Volunteer, please. All right, Khadija, you have the floor.
Okay. Collect and verify inputs. Once you have defined.
Before you go on, what was the first one?
The payroll process begins by defining the payroll policy.
Okay, good. Go ahead. So I want to be sure you are with us.
Okay. Collect and verify inputs. Number 2. Once you have defined the policy, the next step is to start collecting your employees' inputs. This includes employees' tax numbers, addresses, bank details, and other important information. Generally, all this information is collected during the onboarding process. It is crucial that all documents that you receive are verified to check their authenticity.
Very key. So we are explaining this because we never can tell, and for many of you that may decide later on to traveling out, most of the accounting functions are not over there, are not as modeled up as it is in Africa. So you have a number of people that are just payroll accountants. So you need to follow each and every of these procedures. So number one is that, does the organization have a definite payroll policy? If they don't have, you need to introduce it, right? So you need to develop skills in drafting or development of payroll policy. So the next stage is collection and verification of inputs. You know, it's not the accountants that will have recruited the staff, right? So when the HR department makes the recruitment, they are expected to feed the payroll accountants with the necessary recruited staff information, right? So if the organization is in Lagos State, you will need to actually create what we call payer IDs in Lagos State. If it is in Abuja, you will need to create what we call the tax identification number for the individual employees, right? Each and every other state also has their processes. So you need to know what actually works in that very state of residence, right? You also need to clarify where is the address of the employer. You know, this for tax purposes is very, very crucial. If you have a staff that work in Lagos but resides in Ogun State, the tax of that on the emolument of that staff is not expected to be remitted to Lagos State, rather in the state of residence of the staff. So you need to take that into consideration too. Then the bank details of the staff. You need to know whether if the company already has a policy that all the staff should have salary account in a particular bank. So you need to create processes in ensuring that you create you open a bank account, or the HR department opens a bank account for the staff, such that when you are making transfers to various accounts, it can be seamlessly done. Then other important informations. Important information will be the pension fund administrator, which the employee has been using before. But if the employee has no prior PFAs, then you probably may also advise the employee in choosing the appropriate PFA. But no employer should actually impose any PFA on its employees. However, for seamless management of pension-related costs, you can encourage your staff who does not have a prior PFA to using a common PFA among all the staff. But if you have been using a particular PFA before, you are nobody in Nigeria is expected to having 2 or more PFAs. You are not allowed. The maximum you're expected to having is just 1 single PFAs. So if it happens that you already have more than, you have the opportunity to also decide which among the 2 you will want to maintain. So you can then consolidate your contribution to the other one to the most preferred one. Then it is crucial that all the documents you receive are verified. So all the documents that we have explained before, be sure that the right bank details is what you have, so that you won't credit people with the wrong information. You won't credit the wrong person with the right amount of salary. So that is the next stage. Who is volunteering to take in the third one? Any volunteer, please?
I'm here.
Okay, you have the floor, please. Yusuf, right?
Payroll calculation. Yes, sir. Payroll
Yusuf,
calculation.
States?
Abuja, sir.
Okay, that's good.
Payroll calculation. At this stage of payroll management processing, the verified inputs are fed into the payroll system. The system automatically gathers all the required data and accurately calculates the net payment amount. It takes into consideration different inputs like number of days worked, the commission received, necessary deductions, and taxes due.
Okay, so remember that we had been talking about the procedure to management of payroll, and we said that the very first one is defining the payroll policy. And we also talked about the second one, that we said the collection and verification of the inputs, which you have explained. The third one is calculation of the payroll, and we said at this stage of the payroll management processing, the verified inputs are fed into the payroll system. Various organizations has various systems they use in the management of their payroll. Some use various payroll softwares. Some use an Excel spreadsheet to managing the payroll, while some, I want to believe very few or none, use manual process in doing this. You are expected to using, for accuracy purpose, you're expected to using either Excel spreadsheet or a payroll software. The system automatically gathers all the required data and accurately calculates the net payments amount. That is if you are using the payroll software. But if you're using Excel, you have to make sure that you program the Excel template such that to be able to do such for you, right? It takes into consideration different inputs like number of days worked, commission received, if it is in addition to what you have earned before, the basic pay. The necessary deductions such as the pension contribution, the NHF contribution, the life assurance contributions, the HMO, and the likes. So we keep on emphasizing this because it's crucial for you. It's crucial for you to having a fair understanding of this before, as you continue with your work, or if your job process relates to payroll management. I think trying to introducing some of these processes in your payroll management will improve your approach to your work. Then statutory compliance. Every organization is required to comply with payroll laws and regulations as laid out by both the federal and the state governments. So what are some of these payroll laws? One of those payroll laws is that every employer that has a minimum amount of employees in employment, say 5, is expected to ensuring that they get registered for payee and make deductions and remittance every month, right? The statutory period for making remittances for payee is not later than the 10th day after the date the payment is actually made to the employees, right? But for simplicity's sake, what most people do is just to take the 10th month of the following month. But technically speaking, if the organization has the policy of paying their staff on the 20th day of a month, then the payee should be remitted not later than the 10th day after the date of the payment. So among those regulation or statutory laws that they are expected to also adhere to is what we call the pension contributions, right? What is the statutory period for remittance or contributions of pension? Who knows? We know that the statutory period for remittance of your payee should not be should not be more than the 10th day following the month of the payroll. But what is the statutory period for remittance of pension or contributions of pension? Any person? Don't tell me you don't know. Khadija, are you here?
Yes, sir.
What is the statutory period for making pension contribution? This is an interview question. If you are the payroll accountant in your organization and you have deducted the pension contribution both from the staff and that of the employer, what is the latest period you are required to remit to the PFA through the pension fund custodians? Victor, it's not 14 days. It's actually 7 days after the month of deduction. So it means that your pension contribution should be made to the pension fund administrators not later than the 7th day following the month of deduction. Please take note of that. All right, so the next one is, among those statutory contribution is NHF, National Housing Fund. This is also an employee's deductible cost, but what is the statutory period? We've known that the statutory period for remitting payee is the 10th of the following month, latest. Pension is 7th of the following month, latest. What is the statutory period for making the NHF contribution? Who knows? I will call names. Danjuma, you are around. What is the statutory period for remitting NHF? Danjuma, are you there? Okay, Akonde, what is the statutory period for remitting NHF? Jumoke, Ezekiel, what is the statutory period for remitting NHF? Is Grace here? What is the statutory period for remitting NHF? Don't tell me you all don't know this. Okoyemi, what is the statutory period? Okay, because of time, please, these are very salient information we need to know as accountants. I'll take it all over again. The statutory period for payee should not be less than 10th day following the month of deduction. That is the latest, right? But technically, it should be the 10th day after the month, the date of payments. So if the company pays their employee earlier before the end of the month, just count 10th day. But technically, for simplicity, we assume that all salary must have been paid on the last day of the month. So the 10th day of the month following the month of payment of salary is taken as the payee latest payment day, right? The one for pension is still in the same way, the 7th day following the month of payment of salary. But the NHF is the 30th day following the month of payment of salaries. For further information about this, you need to confirm from the NHF Acts. So after this class, by the time we are sharing materials for this class, we'll be sharing what we call the payee regulations. We'll be sharing the Personal Income Tax Act. We'll be sharing the NHF Act, which was revised in 2018. We will share the Pension Reform Act too. So you need to peruse all of these and ascertain not only the date of remittance, but also the rates of remittance. The rate of remittance or contribution on NHF is 2.5% of basic. The rate of contribution of pension is that employees expected to contribute 8% of the addition of their basic housing and transport, while the employer is expected to contribute 10% of the basic housing and transport on the minimum. But I've seen instances whereby some employers choose to make the whole contributions. But if the employer chooses to make the whole contributions, it means the employee cannot claim pension as a deductible or statutory relief. So take note of that. Take note of that. All right. So these are some of the various relevant things you need to know about the process of the payroll. Then the next one is recording into the accounting system. So before this stage, you had vet the policy, you have collected and verified the inputs, you have calculated your payroll, you have also taken cognizance of the various statutory deductions. Now, how do we feed or post these into our various book? So the next thing to do is process all the payroll data into the accounting system. Every company keeps a record of its financial transactions, right? But very importantly here, when you want to, assuming, I want to create a scenario now, I believe everybody is listening. Assuming that an organization that has a total payroll cost of XYZ, identify that its net pay on all the staff in a particular year is 20 million. Net pay is 20 million. Please take notes. Net pay equals 20 million. Pension contributions equals 3 million. NHF contribution equals 1 million.
We can't see your screen, sir.
I'm communicating it on the group, on the chat
Okay.
group.
All right.
Payee equals 500K. So tell me, net pay is 20 million, pension is 3 million, NHF is 1 million, and payee is 500,000. Tell me, how do we make this, how do we record this or record this in the accounting process? How do we post this into the various books? I need somebody to answer this question, please. Anyone? Shall I call names? Danjuma, are you there?
Hello, sir.
Jumoke? Is Danjuma back? Jumoke, are you there? Or who is ready to answer the question?
Hello, sir.
Okay, your name?
Akonde Adetunji, sir.
Okay, you have the floor. Do you understand the question?
Yes, sir.
Okay, tell me how to make this posting in your books.
Okay. The sum of 24,500,000 goes to the expenses as salaries and wages. Why 3 million will goes to pension payable? 1
Please
million.
tell us what you are debiting, what you are crediting.
Okay. I'm sorry, sir.
Okay.
The sum of 24,500,000 will be debited in the P&L as salaries and wages, while the sum of 20 million will be credited as salary payables. The sum of 3 million naira will be pension payable, and NHF 1 million and will be credited. Payee payable also will be credited with the sum of 500,000.
Okay, so that is where you are booking that cost. What then happens after you make the payments?
Okay, upon payment, the bank will be credited and net pay, pension, NHITF, and payee will be debited.
Very good. Very good. Where do you work?
About engineering, sir.
Are you the accountant there?
Yes, sir.
Very good. I'm highly impressed. So please, you need to take cognizance of what's this question, because this is a very crucial way process in the course of managing payroll-related costs. Very many people did not understand these processes. So you need to book the cost by recognizing the whole of the staff costs as salaries and wages or whatever appropriate personnel costs that you have mapped, right? While the corresponding entries goes as payable, so you have net pay payable, pension payable, NHF payable, and payee payable, right? When the payment is eventually made, then you now debit each of the payables whose payment has been made and credit your bank. So this is how to account So I believe this is well understood. Please, if you don't understand this, please quickly ask questions, because this is the most important area among all we are doing in payroll accounting. Any question from anybody?
Sir, please can you remember what the topic? I did not get too far, sir.
Take your question again.
Me too, sir. Sir, recap.
Okay. My question earlier was, you have a company. We assume that they have calculated their payroll and they have completed all the statutory deductions. So they have ascertained a net pay of 20M. They have ascertained a pension of 3M. They have ascertained NHF of 1M, and they've ascertained payee of 500K. How do you post these in the relevant accounts or ledgers? So, and Akande responded by saying that if you had all of these components of cost together, they will give you 24.1.5K. That is the total payroll related cost or personnel cost. So you will debit the whole of that in personnel cost ledger or salaries and wages ledger. And you will credit one by one separately. You have a ledger you will call net pay payable, because you have not paid it, you have just booked the expenses. So net pay payable will be credited with 20M. Pension payable, because it has not been remitted, will be credited with 3M. NHF payable will be credited with 1M. Payee payable will be credited with 500K. Remember that we gave a statutory deadline that each of these statutory deductions are expected to be remitted. We have earlier said that payee should not be remitted later than the 10th day of the following month. So that within the 1st of the following month to the 10th of the following month, this 500K must be remitted to the appropriate LIRS, State's Internal Revenue Service. Then the NHF is expected to be remitted. You can remit it earlier, but you should not remit it later than the 30th day of the following month. Pension, you can remit it earlier, but it should not be remitted later than the 7th day of the following month. While the net pay, the due date for your payment for your offset of your net pay must be in line with your company's policy. Some companies pays on the 20th day of every month. Some companies pays on the last Monday of every month. Some companies pays on the last Friday of every month. So you have to look at the company's policy in terms of the salary payment day and ensure that that disbursement is made on that day. I believe that is well understood. If you are still having any need for clarification, please indicate. For those who asked the question, are you fine with the explanations?
Thank you, sir.
All right. So that is on that. I believe that is well understood. So let's take the next one. So the next one is payout and release, which is what I've just explained. And that should be done in line with the company's policy and the statutory regulations. So next thing we'll be looking at here is understanding how to compute payee and PIT for self-employed, for employees, and high net worth individuals or expatriates. As much as possible, we would like to make this very, very practical. So, in doing this, what are the stages that you need to undergo? Salary earners in Nigeria are mandated by law to pay tax under the pay as you earn scheme. Every month, a portion of your salary is deducted as tax, leaving you with a net pay to take home. Tax under the payee scheme fall under the jurisdictions of the State Internal Revenue Service, meaning that all the tax you pay are remitted to the state of the employee's residence. So what happens if you have an expatriate that earns income in Nigeria, but is not resident in Nigeria? Who should be the relevant tax authority? A question: what happens you have an expatriate who earns income in Nigeria, but he or she is not resident in Nigeria? Which should be the appropriate tax authority? FIRS. Thank you very much. Very much. Thank you very much. So for example, if you live in Ogun State but work in Lagos, you are required or you are liable to pay tax to Ogun State and not Lagos State. That is very, very key. So you need to understand how to make all of these remittance procedure and processes and how to making the computation. Let's look at this. Okay, Khadija raised her hand. You have a question or is it a mistake?
No, it's not a mistake. I have a question.
Okay, you have the floor.
So you were saying that if a person makes makes money from
Francis, you are disturbing us.
Sorry, please.
Okay, so you made a statement that if somebody works in Nigeria, like makes money from Nigeria and lives and does not live in Nigeria.
Yes.
That is FIRS that will be that will collect the tax, that the tax will be paid to FIRS.
Yes.
So, but you now made the statement of, I understand that part. But now you said a person that stays in Ogun State, but the taxes are like the work in Lagos, the tax will be paid to
Francis, I will fight you. Go ahead, Khadija.
Okay, sir. But you now wrote something here. You said somebody that lives in Ogun State but works in Lagos, the tax will be payable to Ogun State government.
Yes. Yes. So what is your question?
Sorry, I thought I muted the mic. Okay, so but is it not different? Is it because of the other one has to do with like different countries and the other one is within states?
Okay, so you know whether you are paying to any state tax authority in Nigeria, we still assume that it's the Nigerian government that collects the taxes.
Yes.
But when you have instances where somebody earns an income from a country and resides in another country, right? That may give rise to what we call double taxation, right? Because in the country where the person actually earns the income, the relevant tax authority in that country, Extra, please mute your mic. The relevant tax authority in that country has a taxing right on that income, right? And in the country of residence of that person too, the relevant tax authority in that country also has a taxing right on that income. But the question is, who has the first taxing rights? The person that has the first taxing right is the tax authority in the country where the income was earned. So it is appropriate that the Nigerian government, in that instance, Lagos State cannot claim the tax, Ogun State cannot claim the tax, and other states in the country cannot claim the tax because the beneficiary of that income is not resident in any states in Nigeria. So in that instances, that is why the FRS has to come in and ensure the collection of that very tax in that instance. So the question now is whether the person in its country of residence will be subjected to another tax. It is all a function of whether Nigeria has a double taxation agreement with that country or whether that country recognizes or reckon with the taxes that must have been suffered on the income of its residents in another country. But let's turn the table. Let's assume that a Nigerian residing in Nigeria actually earns an income outside Nigeria. So let's say he earns income from Ghana. The Ghanaian government will have taxed the income before it gets to Nigeria. Do you understand? So it now depends on, but on the income getting to Nigeria, Nigerian government will still intend to taxing that income. So the question now will be, did Nigerian government has a double taxation agreement with Ghana? If it does not, then the law provides that that amount that must have been paid as tax in that country where the income was earned will be taken as a tax deductible, but the person is still expected to pay tax on its own income. If after recognizing that deductible, the taxable income does not result into zero or negative. But if the Nigerian government already has a double taxation agreement with that country where the tax was initially suffered, then the conditions or the terms of that double taxation agreement we have to prevail. Grace, be guided. So the double taxation agreement today will now come to play, right? So that is, maybe we should just suspend that now because it's a bit complex for those who doesn't have practical knowledge of that. We'll probably in our next training semester, we'll be considering some other complex tax issues around double taxation agreements, taxation of digital income, and some other issues of that nature. But at least you understand what I've explained. Khadija, do you?
Yes, sir. Yes, sir. Thank you so much.
All right. So,
Please, sir.
Okay.
That is Victor. Please, I wanted to clear me one thing, Abek. Like, if a company have a head branch in Cross River, let's say it's Calabar, and have some branches in Ebonyi State, Port Harcourt, and Abuja. Now, if the company want to prepare the payee in the state, is it going to include the names? Is it only the names of the workers that are resident in Cross River State that is going to pay to the entire revenue, remitted to the entire revenue of Cross River State? Hello?
GT Bank.
No.
Hello. Can you hear me?
Yes, sir.
Okay, so what I was trying to explain is, let's take a company like Guarantee Trust Bank that has branches in virtually all the states in Nigeria. So when they prepare their payroll, they compute the payee and ascertain the NHF, ascertain the payee payable and the net pay and other deductions. So how will they remit the tax? They will have to look at the addresses or state of residence of each of these staffs. Some people can be working in Lagos, but they are not residing in Lagos. So you have to sort all the payroll computations and other estimates by the address of residence of these staffs. So for those who are working, who are residents in Lagos, you will then total all their payee and remit to LIRS. For those who are residents in Ogun State, you will then have to sum it up and remit to Ogun State. For those who are resident in Calabar, Cross River, you will sum it up and remit to the Cross River Internal Revenue Service. For those who are residents in Ebonyi, you will do the same. That is how to making those renditions. It does not matter where their head office or business office is. What is more important as far as the law is concerned is remitting according to the state of residence of each of the staff. Is that clear?
Yes, sir, I'm clear.
Okay. So any other question before we go ahead? Please, if you...
Yeah, sir. Okay. So I have one question also to ask, please.
Okay, you have the floor.
Yeah, like, sir, is it any law that state out if you employ someone into your organization, is it that minimum that will take the person for you to start to deduct the payee tax from the employee?
Okay, technically, even if you have one person,
oh no,
you should provide is that you should have minimum of 5 staff before you register as a tax agent. But that does not mean that even if you have one person, they won't come to pursue you if they were aware that you have such payables. Do you understand what I've explained?
Yes, I understand, but the network was very bad, sir.
Okay, so what I'm saying is that the law provides that it's not even a law, it's a regulation. The regulation of Lagos State provides that you should have a minimum of 5 before you can be registered for payee agents. But that is not to say that during tax audits, even if you have one employee, they will not compel you to paying the payee on that one employee. So the big deal is, the underlying factor is the moment you actually incur a taxable payroll cost, you should actually deduct the payee on it and remit it as appropriate. Is that clear?
Yes, sir.
All right, so any other question before we go on? All right, so we look at this instance. Ahmed earns an annual salary package of 3 million, which obviously includes leave allowance. Mr. Ahmed also contributes 2.5% of the basic to the National Housing Fund to enable him secure a loan. So look at this assumption. This particular 3 million salary has been broken down into various components. 38.5% of the amount is basic, 28.8 of the amount of that 3 million is housing, 9.6 is transport, 9.6 is meal, 4.8 is utility. In this instance, leave is 0, and dressing allowance is 0%, entertainment is 4.8%, car allowance is 3.8%. If you add everything together, you have 100%. So this is the amount in this first column represent the amount per month, while the last column represent the amount in per year. So that is the first stage. The second stage is following which we can now apply the consolidated relief. The consolidated relief allowance, you and I knows that it is 20% of your gross income plus 200,000, right? So we have to come to this how do we calculate 20% of your gross income? You have to identify your gross income first, right? So this estimate was actually done on the premise of the old tax law. So you have to look at the total income is 300 million. The consolidated relief allowance is 20% of the gross income. Somebody should compute this particular payee based on the new tax law. What would be the payee? I'm expecting your values. What would it be? What would be the payee? Is somebody calculating? Is somebody calculating? Hello, nobody is responding. Hello, are you all there? So what is the payee, please? Who is calculating for us? Anybody calculating for
Mr.
us?
Kunle,
Yeah.
I can't actually calculate, but can I explain verbally?
Okay, yeah, go ahead, please.
Okay, to arrive at your consolidated tax relief, you first of all have to, all those deductibles like pension and all those things, you deduct it from the gross income. The net of it, you apply the 20% on it, plus the 200. Then you deduct those pension and all that, all those NHIS and all that again to arrive at your chargeable income. Then you start applying the percentage. The first 300 at 7%, second 300 at 11%, the first 500 at 15 and all that. Sorry, I can't actually calculate. I'm driving.
Yeah, thank you. But do you decipher the gross income first?
Yes, to get the gross income, you deduct all those. Can you remove this your picture? Let me see those deductions.
Okay.
Pension, NHIS, and all that. The net, you apply the 20% on it to get the consolidated tax relief. Then you will now deduct the consolidated tax relief plus the pension again, then the NHIS and maybe life insurance, whatever, to arrive at your chargeable income before you start applying the percentage.
Okay, I believe everybody can see my screen now. I've projected an Excel template. Can we all see it?
Mm-hmm.
Okay, so this is what she's trying to explain in. This very staff has a basic of 1.1, housing of 8. I've tried to calculate the percentage out. The housing of 865, the transport of 288, utility of 144, meal of 288, education of 144, then car allowance of 115. Now, when you add everything together, what you have in all is 3 million. So if you want to calculating this before the introduction of the Finance Act, is slightly different. So we'll do the two together and you will see what the difference is. So let's have a look. First of all, we need to ascertain all those reliefs. The pension is 8%. So I do 8% of the sum of the housing, transport, and basic. That is 184,000 in this question. I believe everybody can see that. Please indicate if you can see that.
Yes, we can see that.
Okay, so next one is the NHF, 2.5% of basic alone is this. Now, assuming the question did not have NHF, did not have HMO and other statutory relief, then your gross income, which I explained to be the difference between the total income and all the other reliefs. So we'll say 3 million minus 184 minus 228 will give you your gross income. So you will then be calculating your gross income, your consolidated relief as a function of the gross income. Remember, the law is 20%, the higher of 20% and 1% of the annual income plus the 200,000. So I'll put this into programming here, right? So we can actually put that to test to be sure that it is correct. So we say 20% of the gross income plus 200,000. So what will that give? You notice that even when I calculated it separately, I'm sure everybody can see that it is exactly the same with the programmed amount. Is that clear? So then you will now recompute your what did you call it? The pension you have calculated before, you will still bring it in. The pension we have calculated before, we bring it in. The NHF we have calculated before, you bring it in. So somebody could ask, what is the relevance of this first pension and NHF we have calculated? It is just to help us in ascertaining the gross income, right? So these are the reliefs, right? So you then add all the reliefs together. Add all the reliefs together, that is the CRA plus the pension plus the NHF. This gives us 970. Then your chargeable income is the difference between your total income minus the total reliefs. So it is based on this that you will then estimate your tax payables. So your taxable income, if you had a frank investment income, you will have deducted it. So your taxable income is the same thing as your chargeable income in this instance. So we have also used a program to actually calculate this, but we want to put it to test. The law says, can somebody give us the rates? First 300,000 at what rate, please? I want to be sure that we are all here.
7%.
At 7%.
Okay. That's 21,000.
So we multiply that. Then the next one is what? 300 at what rate? The next 300 at what rate? Who is talking?
11%.
11%. So you multiply that. Then don't forget our chargeable income or taxable income is 2 million. So we have removed this first 300. We have removed this next 300. So conveniently, we can still get the next 500, right? That 500 is at what percentage?
15%.
It's at what percentage, please?
15%.
Okay, so that gives us 75. So when you add the first 300 with 1.5, that is 1.1. So we can still get another 500, right? So the next 500 is at what percentage?
19%.
19%. So if you sum this together, you have 1.6. What is the next rate?
21%.
No. Okay, what is the next base? After 300, 300, 600, 600. I mean, after 300, 300, 500, 500, it should be next what?
1.6.
Is it 1.2?
But you note something. If I put 1.6 here and I had everything together, it's already more than what I want to tax.
So it's balanced.
It means the next one cannot be 1.6. Rather, it will be the difference between 2,029,230.68 minus the difference, minus the sum of all these other ones. That will give me only 429. Technically, if I sum all of this together, it should not be more than my taxable income, right? We are now charging this at what? 21%. So if I add all of the rates together, you will observe that it is equal to 314,138 approximately. So if you look at it approximately, you will notice that it is the same thing with what I have calculated through my programmed templates. So we use this program template for instance, if we have, imagine that I have more than 5,000 or even 10,000 staff to compute their payee. We just use the program template to calculate for everything. We can put it in an horizontal form. So this is actually how to calculating the payee of employees, right? What happens if you are given the income of the employee in months? How do you actually calculate this in months? This is also doable, right? So all you just need to do, okay, let's just take a typical example. Let's assume this person only worked for 3 months. We want to calculate what's the tax will have been times 3 months. So it means that this person in 3 months will have earned 750. So the total income of this person is still 750. I believe everybody is listening. All right. So the pension in that month, over that 3 months, we'll also calculate it in the same manner. But when you get to, what do you call it? The consolidated relief, please listen to this. The consolidated relief allowance, there is a 200,000 here. This 200,000 is actually meant for 12 months. So I will need to adjust this by coming in here and say dividing by 12. Are we together? Multiplying by 3. I will come in here again, I will say dividing by 12, multiplying by 3. So it has programmed this. So what we are trying to say in that 200,000 that we are to add to the 20%, right, is actually for 12 months. So if you are calculating the payee for less than 12 months, you need to prorate that standard 200,000, right? So that is what we mean by that. Then coming to the chargeable income, within this context, the chargeable income is 507. How do we confirm the correctness of this 43,803? You will see what we will do here. Please listen to this, this is very key. You remember that when we are calculating for are you all there? Please indicate. I need you to confirm if you can hear me. Okay, so one thing you need to note is that just the same way we adjusted for the 200,000, all these first 300,000, next 300,000, we have to prorate it by the number of the month if you want to work this to this. So what we need to do is to come in here. This 300,000 represents 12 months. So I'm dividing this by 12, multiplying by 3 months. I'm dividing the next one also by 12, multiplying by 3. Right? So if I had the first 75, is still more than this, is still less than this 507. So I'll come to the next 500. I will divide by 12, multiply by 3. So if I had this, it's still not up to the 500. So the next 500, I will divide by 12, multiply by 3. So if I add everything together, it's still not up to the what do you call it? The taxable income. But the next one should be 1.6. So I will say 1.6 divided by 12 and multiply by 3. If I do that, by the time you add everything together, you will observe that it is more than the 507. So all I need to do is to just say 507,307.67 minus the sum of the above. Now, by the time I had everything together, you see that it equals the 507, right? So technically, we have applied the rates. What this tells us is that this program that we have done is not as accurate as this. So I should have this particular programming at only recognizing annual rates. So this is the correct whatever. For us to use this programmed one, where you have 3.2560 and everything, I ought to divide it by 12, right? So that is why you need to be very watchful when you are computing your payroll and payee. Ensure that you are actually using the appropriate estimate. Please, this is how to checkmate what you have done, whether it is correct or not. So the appropriate payee for 3 months on this particular income is 78,534. Please confirm if you understand this or you have any question. And you will look at it that when I compare what we have calculated for a 12 months, I divided it by 12 and multiplied by 3. You will notice that it gave me the same thing with what we have calculated separately. So please, this is how to making your estimates. Francis, quickly ask your question.
Okay. Good evening, sir.
Good evening.
Please, sorry about the distractions
No,
I was cutting. I was actually on the road. Yeah, so in line with the Finance Act 2001, please, I want to ask, sir, to get the chargeable income, is it that you deduct the total relief from the total income, or is it that you deduct the consolidated allowance from the gross income? I'm a bit
okay,
confused
so
about
what we did first of all is calculate any other deduction other than consolidated relief allowance. So in this question, we only have pension and NHF. We deducted the pension and NHF from the total income to get our gross income. You know, at the beginning of this class, I differentiated gross income from total income for tax purpose, right? So this, our consolidated relief, is calculated on the gross income, not on the total income, right? We then brought in those same pension and NHF that we have earlier calculated, right? So if you add the consolidated relief allowance plus the pension plus the NHF, it gave you 790,000. So getting your chargeable income, you are deducting the total relief, not from the gross income, but from the total income, because this gross income was only required to calculating the CRA alone.
Okay.
Does that answer your question?
Is that what the Act said, the 2021 Act says?
Exactly.
That means we must have been doing a wrong thing in our office.
What have you been doing before now?
What we do is that we deduct the consolidated relief allowance from the gross income to arrive at the chargeable income.
You deduct the consolidated relief from the gross income to arrive at the what?
Chargeable income.
No, that is not. You take note that this pension and NHF that you calculated here, it is deducted from the gross income to arrive at the gross income. It's deducted from the total income to arriving at the gross income, right? So by the time you want to know what is your total relief, your total relief is still consolidated relief allowance plus the pension plus the NHF. Let me give you the thinking of the new act. The thinking is that if this CRA is calculated on the total income, pension is already included, NHF is already included. So if we are calculating components, just look at it. What we have now is 577, 557. If I change the base from gross to total, you will see what change you have now. Just watch it. See what you're having, 800. From that 57. Are you there, Francis?
Yeah, I'm here.
So the thinking of the tax legislators are, since you are recognizing the pension, So by the time you want to calculate the consolidated relief allowance, remove the pension and the NHF from the total income.
Yes. Yes.
Do you understand?
Mhm.
So when we adjust it back, we are having 557. But that 557 plus the 184 plus the 28,000 should be added together to getting your total relief. This 970,000 is now what you will deduct from your total income, not your gross income, to getting your chargeable income.
Okay.
Is that clear? So it's on your chargeable income. If you have frank investment income like dividends and the likes, that is what we call frank income. You will have frank investment income will have deducted that. But since for individuals, employees, that is not usually there, then your taxable income and your chargeable income will be the same. Then apply your tax rate on your chargeable income. Is that clear? So where do you work?
I work with Lubel Nigerian Construction Company, actually.
Okay, so you might need to checkmate this very well with what you've been doing, right? You are based where?
Abuja.
So you might need to, okay. You might need to check this very well with your team and what you've been doing. If it is wrong, please make a proposal on how this could be changed. Do you understand? If your company so desires to, who is this now? If your company so desires to having an in-house training in this regard, be sure I'll be willing to come into facilitating the class for you. But this actually be correct.
The payroll officer was of the opinion that is what the Financial Act of 2021 said. I actually argued with him, but then the management decided to flow with his own.
Do you have a tax consultant?
Yes, we do.
Okay, so you probably might need to also run this for a second opinion.
Call them back and.
What do you say?
I said we may need to call them and let them look at it again.
Exactly.
Based on.
Exactly. All right, so I believe that answers your question.
Very well. Thank you so much, sir.
Okay, so but after you have engaged them, whatsoever they decided, at the end of the day, I would like to have the feedback.
All right, sir. Yes.
Yeah. Adetunji, you have the floor, please.
Good evening, sir.
Good evening.
Sir, my question is, let me just create a scenario, sir. Like someone that is earning 40,000 in a month and the annual salary is 48,000 annually. After deducting all the necessary deductions, including the CRA, most times the taxable income are always less than 300,000, which the tax rate is the first 300,000 at 7%. So to me, I don't know if the way I have been computing it is okay or not. After following all the due processes, whatever is left, maybe like 200,000 or so, I will use the 7%, the 7% to compute the tax on that. I don't know if I'm right or
First of
not.
all, for that person, do you do pension?
Yes.
Okay, let's just create a scenario here. Look at the scenario I'm trying to create in. Assuming the basic salary of the person is 15,000. The housing is 14,000. Let's assume the transport is 10,000. Right, we have 39,000. You said the gross salary, total salary is 48, Abi?
Yes, that is for annual.
Annual, 48,000. Are you sure?
Yes. Yes, I said the monthly salary is 40,000 and the annual should be 48,000. Sorry, 480,000. Sorry, sir.
Okay. So, but in what do you call it? In a month, it is 40,000, right?
Yes.
Okay, so let's make the whole thing ourselves. Let's assume housing is 10,000, transport is 10,000, basics is 15, and let's say utility or others is 5,000. That gives us 40,000. So based on this estimate, the pension will be okay, let's use the annual whatever so that it could suit what you are trying to get in. This times this 12. All right, so you can see that in a year we have had 480,000.
Yes,
Pension
yeah.
in a year is 33. NHF in a year is 45. Gross income is 441,900. Consolidated relief allowance will be 288. Pension will still be 36. NHF will still be 45. Total relief is this. Chargeable income is 153,520 based on this estimate. The tax due on that person should be 10,746. We can check it with our rate here. Let's test it. You know the first rate should be 300,000.
Yes, sir.
But in this instance, this person only have 153. So you put the whole of the 153,520 there. So you can see that what I have in my check is still the same thing with what I have on this. So if you have done the right thing, and that is what you should have. So what is your worry? I mean, what's the thing you want to clarify?
No, what happened is that at the taxable income, the taxable income now is 153,000. So I usually use this 7% to calculate the 153,000 or whatever.
Okay.
So I'm just curious that if I'm right or not.
You're actually correct. You're actually correct. If the taxable income is less than the actual base value, use the actual taxable income. You are very correct.
Thank you, sir.
Thank you too. Any other question? Any other question? Any other question before we call it a day?
Yes, sir. Yes,
okay,
sir.
Esther, make it fast.
Sir, okay, still in line with the question my brother just asked now, where the taxable income is less than, like in this scenario we created, is less than the first 300,000 on the tax table of rates.
Okay.
Where does minimum tax? Is there no minimum tax? You know, before the finance,
minimum tax comes in. Minimum tax comes in where your taxable income is actually negative. Let's create a scenario.
Okay.
Let's assume this is 5,000. This is also 5,000. And this is also 3,000. And this is nil. By the time we calculate everything here, you notice that your chargeable income is negative.
Yes.
Do you understand? And
yes, sir.
What this is telling you is that you have to go back to the government and collect what you have not paid. So in that instance, you will now have calculate the minimum tax rate on the on the total income. Is that clear? So it is because of that that the government wants to rectify and says that if your income is actually less than 30,000 or a maximum of 30,000, don't even bother computing minimum tax. Because as long as you have an income less than 30,000, there is higher likelihood that your computation will be either very low or negative.
Negative.
You understand?
Yes, sir.
So that's why we have that. So I believe we have added another value tonight. Please, I would encourage you to take your
Mr.
time.
Kula, I have a question.
Okay, make it fast. We are past our time.
Okay, I want to know, is it that when your taxable income is less than 30, or when you earn 30,000 or below, you're not expected to pay payee?
No, when you earn less than 30,000, your gross amount is actually 30,000 or less. Not your taxable income, or no. That's your total income.
Per annum, gross.
No,
Sorry,
per month.
Yes.
Per month. Per month. You know, there are
when
some
your
people.
Income is your gross income is 30,000 or below, right?
Not your gross income, your total income.
Okay.
Your total income. You know, there are some people like the cleaners in some companies that will say your monthly salary is 15,000, your monthly salary is 20,000. You have not even calculated any tax at all. Your monthly salary is 25,000. Your monthly salary is 30,000. 30,000 and below, no tax at all. But if it's 31,000, you will calculate and make sure that if there is any tax due, you have to pay.
Okay, thank you.
All right. So please take your time to going through this again, particularly when the material must have been shared, and particularly the statutory deadline for making those returns and contributions. For emphasis sake, again, NHF is 30th day following the month of deductions. Pension is the 7th day following the month of deductions. Payee is the 10th day following the month of deductions and all of that. So I want to believe that we have at least in one way or the other learned another new thing. We can only pray and trust that God will continue to crown our effort with success, and trust that all that we know will not just be in vain. God will open doors of mercy unto us, such that we have good things to reap from all that we have learned. We have ways to add values to our employers' work and our clients' work, and through that, we'll meet our own helper that will bless us too. So I want to wish you a very good evening and thank you for your time. I also want to express my sincere gratitude to all the Abuja residents. The treat today, I didn't expect it. Thank you so much. What I intend doing eventually for calling for that meeting was to fund the entertainment, but shockingly, Grace and Co. and the rest of the crew, Danjuma and Co., they had paid before I even made efforts. God bless you. I sincerely appreciate you. Ibadan, watch out. We are coming to Ibadan very soon. And in Lagos and Co. We also need to coordinate ourselves. So please, this is not just about eating alone. We want to, the vision and the intention is about actually creating a bond among these particular members of this session, this semester, and let's see a way where we can actually rub skill on each other, be of help to each other, and build what we call a social capital, right? Some of us are working in tax authority, tax offices, while some people are in regular companies. You might have a tax issue and you just walk to your colleague who is working in the tax office and they will help you in simplifying your case. Some people are in a better place of work. You might walk into a company and you see that it's just your colleague on this platform that is interviewing you. That will make a smooth journey. And you might be even be prospecting for an engagement and you find out that a member of this platform is a CFO that will approve your proposal. You can imagine the opportunities are countless. Not as though we are looking forward to being a beggar begging from anybody, no. But it's worthwhile when we rub the opportunity and the skills we have on each other. I pray God will continue to crown all our effort with success. I look forward to seeing you in tomorrow's session again. Have a very pleasant evening.
Amen. Say you, sir. God bless you.
Thank you very much. God bless you.
Thank you too.
Thank you so much, sir. God bless you.
Yeah.
Sakule, thank you. God bless you.
Yeah. Grace, thank you for your gift.
Thank you. I just got home. Hold up.
Okay.
Enjoyment.
Grace give me another gift in addition to the meal. You can see what she gave to me.
Wow.
Yeah.
Wow.
Thank
Grace,
you.
thank you. God bless
Grace, thank
you.
you for the gift. Thank you.
Everyone, thank you.
She gave this device that could aid the lecturing. So it's a wireless speaker for.
Wow. Wow.
Help me bless
That's
her.
nice of you, Grace.
Thank you so much.
Thank you all. I appreciate you so much, Mr. Kunle.
Thank you. Good night, everyone.
Yeah, good night.
Good night, everyone.